In our previous video, we reviewed some highlights of Seth Klarman's book, Margin of Safety. Today, we'll be discussing the topic of business valuation based on the chapter titled The Art of Business Valuation. We won't go over valuation models that are typically covered in textbooks. Instead, we'll focus on a few important issues to keep in mind when valuing assets.
Seth Klarman writes, "Many investors insist on affixing exact values to their investments, seeking precision in an imprecise world. But business value cannot be precisely determined. Any attempt to value businesses with precision will yield values that are precisely inaccurate."
The reasons are as follows. Firstly, unlike debt instruments, businesses do not have contractual cash flows. When cash flows are contractually determined, as in the case of a bond, and when all payments are received when due, some calculations allow investors to quantify their returns under one set of assumptions. Businesses do not have such predictability, and therefore cannot be valued with the same level of precision. Secondly, while financial statements provide a starting point for analyzing a company's financial health, they are only one piece of the puzzle. Other factors such as industry trends, competitive landscape, management quality, and macroeconomic conditions must also be taken into account. Thirdly, business value is not a static concept. It can change over time as a company grows or faces challenges, as market conditions evolve, and as new competitors enter the space. So, investors have to rely on estimates and approximations when it comes to valuing businesses. Our goal should be to seek a value range, or a rough estimate. Anyway, it's better to be roughly right than precisely wrong. When future cash flows are reasonably predictable and an appropriate discount rate can be chosen, net present value analysis is one of the most accurate and precise methods of valuation. Unfortunately, future cash flows are usually uncertain, often highly so. Also, choosing a discount rate can be somewhat arbitrary. These factors together usually make present value analysis an imprecise and challenging task. Real businesses, even the best ones, aren't like annuities. It's pretty rare to find a business that has an unbreakable market niche and generates consistently high returns, because most of them face serious competition. Even small changes in revenues or expenses can cause greater percentage changes in profits. There are way more things that can go wrong than can go right.
Klarman writes, "Responding to business uncertainty is the job of corporate management. However, controlling or preventing uncertainty is generally beyond management's ability and should not be expected by investors. Although some businesses are more stable than others and therefore more predictable, estimating future cash flow for a business is usually a guessing game. A recurring theme in this book is that the future is not predictable, except within fairly wide boundaries."
Many investors base their decisions entirely on their own predictions of future growth. It's true that the faster a business's earnings or cash flow grows, the higher its present value. However, Klarman points out that growth-oriented investors face several challenges.
First, such investors frequently demonstrate higher confidence in their ability to predict the future than is warranted. Second, for fast-growing businesses, even small differences in one's estimate of annual growth rates can have a tremendous impact on valuation. Moreover, with so many investors attempting to buy stock in growth companies, the prices of the consensus choices may reach levels unsupported by fundamentals.
So, how do value investors predict the unpredictable? The only answer is simple: be conservative. Since all projections are prone to error, overly optimistic ones can put investors in a risky position. Conservative forecasts are more likely to be met or even surpassed. The best approach for investors is to make conservative projections and then invest only when there's a significant discount from the valuations derived from those projections. This strategy helps minimize risk while maximizing potential returns.
The discount rate is the rate of interest that would make an investor indifferent between present and future dollars. Each person's opportunity cost and preferences vary, which may result in different choices of discount rates. It's important to know that there's no single correct discount rate for a set of future cash flows, and no precise way to choose one. The appropriate discount rate for a specific investment depends on several factors, including an investor's preference for enjoying their money now versus later, their risk profile, the perceived risk of the investment they're considering, and the returns they could get from other investment options.
A short-term, risk-free investment should be discounted at the yield available on short-term U.S. government bonds, which are considered safe investments. On the other hand, low-grade bonds are discounted by the market at rates of 12 to 15% or more, reflecting investors' uncertainty about whether the contractual cash flows will be paid in full.
Klarman writes, "It is essential that investors choose discount rates as conservatively as they forecast future cash flows. Depending on the timing and magnitude of the cash flows, even modest differences in the discount rate can have a considerable impact on the present value calculation."
Private market value is an investor's assessment of the price that a sophisticated business person would be willing to pay for a business, based on the multiples paid when comparable businesses were previously bought and sold.
Klarman points out, within a given business or industry, all companies are not the same, but private market value fails to distinguish among them. Moreover, the multiples paid to acquire businesses vary over time. Valuations may have changed since the most recent similar transaction. Finally, buyers of businesses do not necessarily pay reasonable, intelligent prices. The validity of private market value depends on the assumption that business people know what they are doing.
How do sophisticated private market buyers themselves evaluate businesses for possible purchase? Private market buyers use present value analysis to evaluate potential investments. The key difference between private market value analysis and present value analysis is the involvement of a middleman, typically a sophisticated business person. But the middleman's level of knowledge and insight may not be reliable, leading investors to become complacent and neglect their own independent valuations.
Klarman writes, "My personal rule is that investors should value businesses based on what they themselves, not others, would pay to own them. At most, private market value should be used as one of several inputs in the valuation process, and not as the exclusive final arbiter of value."
Due to the length of this video, we will conclude our discussion of the margin of safety here. Please subscribe to our channel to stay updated on our future discussions of value investing. The more we discuss, the more we learn. So don't hesitate to share your thoughts and comments below the video. Let's discuss them together.